Hey everyone, today I'm diving into key audit risks related to financial statements and how to respond to them. First up, let's talk about the refurbishment of assembly lines. There's a risk that these costs have been incorrectly capitalized, overstating non-current assets. Auditors should review refurbishment costs carefully, verify proper classification, perform substantive testing on capitalized amounts, and review disclosures in the financial statements. Next, inventory valuation and existence. Using a third-party storage provider can increase the risk of misstated inventory balances. Plus, there's the risk of inventory obsolescence if stock remains unsold for long periods. Auditors should obtain confirmations from the third-party storage provider, reconcile these with client records, and if necessary, perform inventory counts at third-party locations. Now let's talk about e-commerce revenue recognition. With the rise of online sales, there's a risk of incorrect revenue recognition. Automated systems might record revenue at the wrong time. Auditors should assess whether revenue is recognized according to applicable accounting standards, test IT system controls for accuracy and completeness, and perform substantive testing on a sample of e-commerce transactions. Doubtful debts from retail customers are another area of concern. Some customers struggle to pay outstanding balances, risking overstatement of trade receivables. Auditors should review the aging analysis of receivables, assess the adequacy of the allowance for doubtful debts, obtain confirmations from major customers, and perform subsequent cash receipt testing to verify recoverability. A planned stock exchange listing can increase the risk of financial statement manipulation, as management might try to present more favorable financials to attract investors. Auditors should maintain professional skepticism, review key estimates and judgments for potential bias, perform analytical procedures on revenue and profit trends, and assess the appropriateness of accounting policies. Redundancy costs, especially with sales team layoffs, are another risk. These restructuring costs might not be recorded in the correct period or could be misstated. Auditors should verify the timing and classification of redundancy costs, review payroll records and termination agreements, and ensure proper disclosure in the financial statements. Market shifts and going concern issues are crucial. Declining retail sales and financial difficulties could impact the company's ability to continue as a going concern. Auditors should assess management's forecasts, review post-year-end sales, and evaluate the adequacy of going concern disclosures in the financial statements. Lastly, development costs of a website might be improperly capitalized, leading to potential misstatement. Auditors should review the nature of these costs, assess if they meet capitalization criteria, examine supporting documentation, and ensure appropriate amortization policies are applied. That's all for today. Keep these audit risks and responses in mind to ensure your financials are safe and sound. Thanks for watching.